Hi, I'm Michael Newrock, and welcome to the Law of Diminishing Risk and Profit Amplification. This lesson could help with your enhanced use of the Trend Profiteer trading system. It's fairly advanced. There's quite a bit of theory, but it's good to be aware of the options that are available to you. So we're not going to be covering any trade setups, levels, or whatever it happens to be. We're going to be going over primarily how to structure your trade and how to take advantage of these setups in a structural way of how you're investing. So, the law of diminishing risk and profit amplification allows the trader to place themselves in improved trading positions in order to make disproportionately large gains in their account. Diminishing risk is rarely understood, and not being able to amplify profits is a common mistake by traders leaving money on the table instead of taking advantage of scenarios when they can profit more. By trading smart and only ever risking, for example, 1% of your account, but leveraging 3 to 5% returns when you trade, you place yourself in a position to dramatically increase your account balance. In the same manner, trading as an informed speculator, you may find that a 4% risk could generate 12% to 20% increase in your account's balance if you catch a move that returns 3 to 5 times the original risk. Once you understand how this law works and how to apply it, you can start exploiting this trading advantage whenever you wish for the sole purpose of maximizing returns. After all, that's what it's all about. My hope is that you take this information and apply it to your Trend Profiteer trades as a positive contribution to your results. So, how can you diminish risk effectively? Entering trades at the same lot size per trade, or entering trades with reduced relative lot sizes based on a percentage of your account per trade. The stop loss in pips will always be different depending on the time frame used, the pair traded, and the general trade setup. The stop is always placed beyond the slow moving average as per the Trend Profiteer trading rules. So even if you trade only one time frame and one pair, the stop will be different on all trades you take because the dynamic trade setup covering all market conditions. Some stops will be only 10 pips, while others will be 20, 30, 40, 50, 100, or even more. Therefore, if you want to risk the same amount as a proportion of your account, you need to adjust your lot size in all trades based on a percentage of your trading account. So in other words, if you trade one lot per trade, rather than doing that, you need to consider adjusting your lot size so you're genuinely risking a percentage of your account rather than a dynamic amount based on the same lot size because of the fact that the stop loss does differ quite dramatically. So how can you amplify profits significantly? Entering trades at the same lot size per trade, or entering trades with increased relative lot sizes based on a percentage of your account per trade. So a bit of a mirror reverse of what we were just going over. Just like reducing the risk, when you increase the risk, the stop loss in pips will always be different depending on the time frame used, the pair traded, and the general trade setup. So same there. On all trades, you can adjust your lot size to amplify profits by increasing the lot sizes used on the trade. And I will go over some examples, of course, in this lesson. So if the trade setup appears to be a high probability trade and only requires a small stop, but has a big potential target, you can keep your lot size at what you normally trade, or you can increase the lot size used without necessarily increasing your risk based on the reduced stop loss used. So let's look at a simple example. You normally use one lot on a pair where one lot equals $1, say just for simplistic purposes. If you normally risk 100 pips, that would equal $100 risked at $1 a pip. If your target is 100 pips, your return is $100 if your trade hits the target. If you entered a trade that only requires a stop loss of 50 pips, okay, half of the 100 pips we were looking at before, you could double your lot size to 2 lots, which would be at one lot equals $1, so 2 lots equals $2 per pip, and still only risk $100 because your stop loss is 50 pips now, not 100. If the target is 100 pips, your return would be $200 if your trade hits the target. If the trade is the same risk reward ratio as above, 1 to 1, you would generate $100 at 50 pips, half the pips required. And if you entered a trade which only requires 20 pips, you could increase your lot size to 5 lots and still only risk $100. Okay. If the target is 100 pips, you then can generate $500 instead of only $100 had you left your lot size the same at your standard one lot size. Or if your target is only 20 pips with the same 1-to-1 ratio, you would make $100 by hitting a target of just 20 pips. So there's a few advantages to trading in this way. And of course, it depends on the trade setup. But the whole idea is when you have those trade setups, you can use this creative structuring of your trades to minimize your risk and maximize your rewards. So when considering any trade, the first question you should ask yourself is, how much am I willing to lose? When we trade, we talk in pips, but it's important to translate this into real monetary terms that can be clearly understood. If you are basing your potential loss as a percentage of your account, then set it to 1% of your account to start with. This is a prudent trading practice, particularly as you may have more than one trade active. So if for example, you have 4 trades open at 1% each, and if they all go bad, which can and does happen, then you are actually risking 4% of your account. So 4 trades at 1% each equals a 4% exposure to your account. If you lost that amount 5 times in a row, you're down 20%. So you need to be very aware of the risk you take per trade and very wary of multiple trades until you know how to manage them. Obviously, the key there is profit locking, and then you can enter new trades without exposing your account on multiple trades. As you gain experience and confidence in the system, depending on your ability as a trader, you can choose to risk more if you have a valid reason for doing so. If, for example, you can choose to risk 2%, 3%, 4%, or 5% if you have a compelling, significant reasons for taking the trade, regardless of whether they are technical or fundamental, or a combination of both. When calculating a percentage of your account, you need to multiply the amount of pips you are using for your stop loss by the value per pip, based on the lot size you are using for your trade. Here are 3 examples to consider. Okay, number 1, you have a $10,000 account, you are trading $1 value per pip, you're risking 100 pips. This scenario would equate to a $100 monetary risk, representing a risk of 1% of your total account. You set your stop loss to 200 pips, but trade 0.5 of a lot value per pip. You are still risking only 50 cents value per pip. So you are still risking only $100 or 1% of your account, even though your stop loss is 200 pips as opposed to 100 pips, because your lot value has halved. You keep your stop loss at 100 pips, but trade 0.25 cents, that's at 25 cents per pip, thereby only risking $25 or 0.25% of your account. When excellent technical setups occur in ideal market conditions, it's possible to exploit these opportunities by giving yourself an improved position to make a disproportionately large gain in your account. For example, if you enter a trade with an ideal setup at the right time under the right conditions, and you've amplified your potential profits by increasing your standard lot size of 1 lot to 4 lots, 4 times what you would normally trade, while still only risking a capped amount of 1% of your account because of the reduced number of pips required, then you're in an excellent position to potentially realize huge gains in your account of 5%, 10%, 15%, or higher from just one trade. And it's these occasional trades that are great to capitalize on when you do, as I was going over before, see a trade setup that is extremely good for a number of reasons, then and the risk in stop loss size is small, then you have that opportunity to increase the lot size that you trade without risking more, but uh, having the opportunity to gain significantly more from that trade. In the mentioned example, you've risked only 1% to gain 5 or 10%. This is a very powerful way to manage your capital growth by keeping your potential risks within conservative guidelines while giving yourself the opportunity to profit like a profiteer by exploiting large returns from every trade. With Trend Profiteer, as well as capitalizing on these ideal trade scenarios, you can exploit the short time frames like the 5-minute and 15-minute time frames, provided that strong fundamentals exist in the higher time frames. So this allows you to get in early before the trend starts to really take off on the 1 hour and the 4 hour time frames. So you can lock in your profits at your profit locking targets and trail the trend for as long as possible on the higher time frames. Now, if you can do that, uh, you're risking less pips, you're going for bigger rewards, and you're giving yourself the opportunity to increase the lot size, thereby magnifying your potential returns. These short time frames only require a small amount of pips, such as 10 or 20 pips, yet can generate a disproportionate return by trading multiple time frames simultaneously. And we go over that in various other lessons and examples. But that's the whole idea of being able to catch these trades that are within a trend, within a trend, within a trend. And it's those opportunities that allow you to get into these trade setups that I'm talking about, where the risk in lot size is very small, and thereby allowing you to use a lot size that is bigger than what you would normally trade, thereby giving you that magnification or amplification advantage. If you normally trade the 1 hour or 4 hour time frame, trading these shorter time frames for technical entry setups in synchronization to the 1 hour or 4 hour time frame enables the exploitation of bigger potential profits by increased lot sizes with greater potential while keeping risk low. Okay, let's go over the reward multiplier. Once you've established your stop loss and pips from your entry price, you should determine what your main take profit target will be. When setting this target, you should think of it in terms of a multiplier of the stop loss. In other words, you want to generate a return in pips as a multiple of the stop loss. This is otherwise known as the reward to risk ratio, but I often refer to it as the reward multiplier. It is the opposite of the risk to reward ratio, but same thing, just said in a different way. If you choose 2 as the multiplier, you're using a reward to risk ratio of 2 to 1, enabling you to generate twice as much as you're risking. A multiplier of 3 infers a reward to risk ratio of 3 to 1 and enables you to generate 3 times as much as you are risking. And this is important because in the Trend Profiteer Trader system, it allows you to put in the multiplier for your for both positions if you are trading 2 positions as a multiplier of the dynamically generated stop loss. So, throughout this course, you'll be able to see how the theory mixes in with the practical, and of course it gives you a better understanding and ability to use the system in practice in the real world. A multiplier of 5 infers a reward to risk ratio of 5 to 1 and enables you to generate 5 times as much as you are risking. 7 infers a reward multiplier of 7 to 1, and so on. Personally, I'm always striving to catch the big moves and lock in profits as I hold a position. Typically, I move my stops at 3 predetermined profit locking points to lock in profits, then trail the trade for as long as possible after that. My reward multiplier for my main targets is normally 5 to 20, meaning my reward to risk ratio is between 5 to 1 and 20 to 1. Now, they're idealistic in nature, but the whole idea is to be able to manage your trade, throughout the trade life cycle. And of course, Trend Profiteer Trade Assistant allows you to be able to do that without you having to manually watch it and react to market conditions as they happen. So these ultimate targets should be idealistic in nature because you don't know how long the trend is going to go for. It may very well go much longer than you think, particularly if the shorter time frames lead into the higher time frames, and before you know it, it's on a full-blown move in your intended direction on both the short term and the higher term uh, time frames. So I use profit locking targets before I start the trail, and I prefer to set the first profit locking target when stops are first moved to a multiplier of 2. That's a 2-to-1 reward to risk ratio. However, I do use a straight 1-to-1 ratio at times, depending on the market conditions. So if the market moves against me after the first profit locking target, I've still secured some profits. And we go into uh, how to where to place your targets. They should be customized for every different trade, depending on the market. We go over that in another lesson, I think, zone profiteering. So have a look at that if you haven't already. Naturally, when setting my targets reward multipliers, I'm guided by previous points of interest such as highs, lows, and significant levels. The potential multiplier is another factor in determining my lot size for the trade. Here's an example showing a reward multiplier of 6, meaning that the reward in pips was 6 times bigger than the initial stop loss. Um, the chart shows it as a representation of the risk-reward ratio, but whichever way it's expressed, as I mentioned earlier, the multiple and the results are the same. So let's have a look. If we had a trade entry around here, stop loss position actually could have made it quite a bit higher. This is one of those examples where I've shown it as a multiple of the reward to risk multiple of 6 here, or a risk to reward ratio of 1 to 6. But in actual fact, it could have probably been twice as much as that. As you can see, this trade just went up straight away, and the stop could have been placed half of that. In that case, we would have had a multiple of around 12 being reached. But it gives you an opportunity to see from all the theory that I've been going over in this lesson, how where in some trade setups you can be in a position where you're risking very little, and that allows you to increase your lot size and without increasing your monetary risk as a percentage of your account. Now, if you do that and you catch some nice trades from time to time that go very well in your direction, that is how you can significantly increase the account size of your account. Um, so by using this strategy, succeeding on a regular basis and doing it with increased lot sizes because of being able to take advantage of a good trade setup, it's very possible that you may see significant increases in your account balance quickly and easily. Even just a 2-to-1 reward to risk ratio, that is a 1 to 2 risk to reward ratio, in addition to amplifying your potential profits with increased lot sizes while not increasing your risk exposure, will potentially produce significant gains. At the end of the day, it's not just about trading smart, but amplifying your profits in a smart way while maintaining low risk exposure. So trades come along all the time, new trade setups, but really good trade setups come along less frequently. So it's important to take those opportunities and amplify them, so your account can benefit from those trading opportunities. Reducing your stop loss size can reduce your exposure to risk, provided that you leave your lot size as a standard lot size you would typically use to trade the pair and time frame. Okay, so for example, if your standard stop loss is 40 pips, then reducing it to 30 pips exposes you to only 75% of the original risk. Likewise, reducing the stop loss to 20 pips exposes you to only 50% of the original risk. Reducing your stop to 10 exposes you only to 25% of the original risk. So, the smaller your stop loss size, the less exposed you are to risk, and you can reduce your risk. It's not just about increasing your lot size. You can go the other way. You can decrease your lot size, but you can do it the other way, where you can reduce your stop loss and not have to reduce your lot size. So there's all these different combinations that you can use, both in diminishing risk and amplifying profits. I'm sure that you can see at times it may be a good option to reduce your risk by simply reducing the stop loss size, especially when you're looking at getting into a momentum trade without much risk exposure. Conversely, increasing your stop loss size can increase your exposure to risk if you leave your lot size as a standard lot size you would typically use to trade the pair and time frame. For example, if your standard stop loss is 40 pips, then increasing it to 50 pips exposes you to an additional 25% of the original risk. Likewise, increasing the stop loss to 60 pips exposes you to an additional 50%, and so on. So increasing your stop loss to 70 pips exposes you to 75% of the original risk in addition. So if you increase your stop loss, you are exposing yourself to additional risk, and I would therefore suggest you counter this exposure by adjusting your lot size to ensure the total monetary risk is contained. Reducing the stop loss, or the lot size rather, traded can also reduce your exposure to the risk, provided that the stop loss is the same as it would normally be for the type of trade setup you are entering. However, if you reduce your lot size but increase your stop loss, then you can keep your total risk the same while giving your trade more room to move. For example, you reduce your lot size from one lot to half a lot, but you increase your stop loss from 50 pips to 100 pips. That is, one lot by 50 pips equals $50 at a dollar a lot. A dollar a pip on a one lot, and half a lot multiplied by 100 pips equals the same $50. There are examples of adjusting your lot size and stop loss without increasing your risk exposure. Conversely, increasing the lot size traded can increase your exposure to the risk, provided that the stop loss is the same as it would normally be for the type of trade setup. However, if you increase your lot size but decrease your stop loss, then you can keep your total risk the same and potentially benefit from the opportunity. For example, you increase your lot size from half a lot to one lot, but you decrease your stop loss from 100 pips to 50 pips. That is, half a lot times 100 pips equals $50, and one lot times 50 pips equals $50. So examples of adjusting your lot size and stop loss without increasing your risk. When trading, you need to accept that you are ultimately speculating and your primary goal is to make profits. So, therefore, you should always be focused on profiting as much as possible. If you do that, you have a better chance of succeeding as a Forex trader. As the trading truism goes, no one ever went broke from taking profits. Have you ever gone into a casino? The slot machines, aka one-arm bandits, are typically a game of pure luck, while blackjack has an element of skill involved and therefore a game that you can exploit much more readily than a pure game of chance. For example, playing blackjack with the commonly practiced basic strategy, knowing the exact probabilities of every combination can significantly improve your chances of success. So too, horse racing has an element of skill involved that can place yourself in a better position to speculate. For example, just comparing the trainer win stats, jockey win stats, and prize money for the last race the horse ran in puts a punter in a better position to pick the winning horse rather than just by guessing. And I'm no expert, but the point that I'm making is in Forex, we have a lot of resources at our disposal to help us determine the immediate future of a particular pair we are trading, including the fundamental information about different economies and their related currency, as well as all the technical information we have on the current trend, the higher time frame trends, and the particular trade setup that combines numerous other filters that are specifically designed to alert us of high probability opportunities. Therefore, it is completely prudent, in my opinion, to adjust our lot sizes and initial stops so they reduce any associated risk of action to a minimal amount while enabling us to ensure a very big reward relative to the risk when the trade does generate a successful outcome. The following example outlines a theoretical guide to how you can speculate some of your profits to potentially maximize earnings. So this is called base equity speculating. Here are the guidelines. I, and it's just a simplistic scenario, but it would go something like this. I start my trading with a risk of 3% of my total capital on any trade. When I have 3 winners in a row, I risk 4.5% of my total capital. If I have a loss, I revert back to risking no more than 3%. If I have 2 losses in a row, I will risk only 1.5% of total capital. If I have 4 losses in a row, I risk 1% of my base equity. Until I have 2 winners, then I raise my risk back to 3%. So this is different again to what I've been talking about today in terms of um, decreasing or increasing your stop loss or decreasing or increasing your lot sizes for the purpose of diminishing risk and amplifying profits. This is more of a money management strategy that is the total opposite of double downing, for example, where some traders will have a losing trade and then double up on the on the trade. They are really betting. So this is the opposite of that by reinvesting some of your profits when you are winning into bigger proportional trades. However, having said all of that, please keep in mind of the things that I've been discussing about trade setups and not blindly go into this as a kind of system. It's just here to add to what I've already gone over. So let's have a look at an example, and these again just purely for the sake of the exercise. So let's say you had 100,000 equity in your account. You risked 3,000 at 3%, and you ended up doing well at 6,876 in profit for that trade. Brings your new equity to 106,876. Your next trade, you trade 3% of not of the 100,000, but of the current balance, which is 106,876. That trade happens to go well as well. You're on over 111. The next trade at 3% of 100 is now of the current balance, 111,752. Let's just say that you succeeded on that trade as well. Now you're up to 119,000. So you've had 1, 2, 3 winners. You increase your risk exposure to 4.5% of your account, and that's 4.5% of the current account, which would be 119,628. He happened to succeed on that. 4.5% of the new balance, 128. Let's say that you lost that one, you're down to 123, and your trading uh, amount that you are risking is dropped down now from 4.5% to 3%. 3% on the new balance, 123. Let's say you get another loss, takes you down to 119, and then you drop it down from 3% to 1.5%. Let's say you lost that one as well. You would you'd keep it at 1.5%. You'd have 2 losses in a row. You'd reduce it to 1%, 2 winners in a row, and then you're back up to 3%. So again, this is just just I thought I'd throw this in to what we've been discussing as far as increasing and decreasing lot sizes and stop loss. But um, again, it's a bit too simplistic because we are dealing with trade setups and as opposed to the way cards fall on a table. But it's these trade setups that you need to be really aware of. Not all trade setups are equal. Some are a little bit more risky than others. Some require bigger stops than others. Some are just ideal setups when they're positioned at a significant level. They don't require a large stop loss, and they're the opportunities that you can benefit on by increasing your lot sizes, amplifying those profits, and reinvesting some of your profits into those bigger trades. So with this system that I just went over, we're trading larger sums when we are winning and smaller sums when we are losing, okay, as opposed to the double down system. Another way of looking at it is that when you are winning, you are reinvesting some of your profits in the bigger trade positions to generate bigger returns with your profits. And when you are losing, you are reducing the amount you trade to preserve your capital during these times, which is something that you need to be really, really careful of. When you are losing, it's a good idea to reduce your lot sizes until you start winning again. Of course, that's very simplistic in nature as well. But please come along to the webinars that we're holding regularly, and we'll be able to go over setup, by setup on a live basis, and you'll start to get the idea will become more clearer to you when you should maybe not risk too much in this particular trade, but give it a shot, and when you should consider the opportunity to amplify your profits while, remember, not increasing or significantly increasing your risk exposure by doing the things that we've gone over in this lesson. So in other words, you're speculating more in the good times and speculating less in the bad times. This has proven to be a powerful and stable method to use in purely speculative markets. So why not bring that into your trading as well? Don't get out of desperation and increase your exposure when you're losing. That's not a good thing to do. I hope that has helped. Regardless of whether the law of diminishing risk and profit amplification is utilized or not, trading with Trend Profiteer can typically generate great results. However, you may see some real positive effect on your account balance by deploying the tactics outlined in this report. Go slow, take it easy, and of course in the forum as well, we can look at trade setups on a case-by-case basis as well. Not all trade setups are equal, as I was going over before. In my opinion, by adjusting your risk and the reward potential, you are placing yourself in a distinct advantage to potentially grow your account in an accelerated manner while managing it prudently. Take time to consider whether you want to utilize it with your trading, even if it's just on the occasional trade when the trade setup is strong and the market conditions are very favorable. I'm confident you could enjoy significant increases to your account balance when the results are positive. Naturally, how your capital grows is dependent on you and the trading decisions you make on entry positions and general trade management, as well as how you adjust the risk to your account on a trade-by-trade basis. In closing, I suggest you implement the minimizing of risk and amplifying of profits whenever you can. I look forward to seeing you generate some positive results with these trading tactics. Again, participate in the forum, come along to the webinars, get involved with the chat room as well. And by being around other traders, it can really help your journey as a trader. Till next time, good trading, live well, and I'll see you soon.